Welcome to the Rodcast with Rod Turner, the show all about real estate. We discuss everything that affects asset-backed businesses, investments, and go deep into the details with some of the best in the business.
Hello everyone and welcome to another episode of the Rodcast. Today my guest is the founder of specialist investment group G2M. They specialise in investing in existing residential properties. So welcome, Paul Morton. How are you?
I'm very well. Thank you very much for having me, Rod.
So Paul, give us a bit of background. How did you come to start G2M?
So my background's actually in finance. So I was a chartered accountant and then Price Waterhouse, and then left there and went into M&A and venture capital. Always had an interest in property and residential property, rental property. I bought my first property at university, thanks to the help of my father, which is another story. And then we exited the venture capital business and then met up with my co-founder, Steve Gardner, who was a property trader. And so at that point, we then morphed into a sort of a private wealth preservation vehicle that was really just focused on property trading and not much rental. And then from there, we sort of grew into where we are today. So morphed in initially with some third-party private individual wealth, and then latterly institutional capital, and sort of developed the model to where we are now.
And so what is it that the problem that G2M is solving then? What is it that you do? Explain to the audience.
So for, I think everyone's very aware that in the UK today, we have a shortage of housing supply, and we're simply not building enough. But within that housing stock, we also have a significant shortage of rental homes, and those rental homes are, from a private rental home perspective, almost entirely owned by private individuals. And so the supply of those homes are not only driven by what we build and what ultimately ends up becoming a rental market, but also what's happening to that landlord community. And there are around sort of 6 million plus private rental homes. And with increasing regulation in the market and with increasing demands for energy improvements and tax changes, those landlords are starting to feel greater exit motivation, and so starting to leave the market. And they're also aging. That buy-to-let landlord average age is around 60. So as they start to exit the market, what happens? You're getting a contraction of rental homes, and that's most keenly felt in those that are average and lower income households. So in those sort of households that are just about managing, what you see is a contraction of the rental opportunities for that market. So for G2M, we are targeting really those particularly landlords that are exiting that market and trying to sit in their shoes and acquire that stock and preserve and protect those affordable rental opportunities for families that rely upon them.
Brilliant. And we've seen kind of institutional money start to get a little bit interested in residential property in the UK over the last few years, but they seem to have stayed out of UK, whereas you go to other markets like the US, Germany, Italy, where institutions have been investing in residential for decades. Why is it that they've stayed away from the UK residential scene, do you think?
I think there's a number of reasons for that. I think one is the maturity of the asset class in the US and the maturity of the investor in investing into that stock. But I think there's also then peculiarities around the UK market. So if you go back sort of 4 decades ago under Thatcher and the 80s, there was a huge drive for the UK becoming a home owning democracy of driving wealth through home ownership. And there's huge amounts of incentives for that. Deregulation of the banking market and also the advent of the buy-to-let mortgage, enabling people to not only buy a home to own, but also buy a home to rent. And so what we've had is over the last few decades, a rapid increase in the owner-occupier sector and the private rental sector, all driven by demand from private individuals. And so from an institutional perspective, it's been very hard to compete with that. It's a very fragmented market. And so much of the stock, or pretty much predominantly all of the stock that's been being built, has ultimately ended up in private sale through to either buy-to-let landlords or through to owner-occupiers. And so the ability to compete with that has just not been possible for institutions until fairly recently, when those dynamics are starting to change. So I think it's really been the owner-occupied demand drivers that have driven individuals to the market and made it very, very hard for institutions to access.
And the appetite that does seem to be coming around at the moment seems like there's a lot of talk now about single-family homes, but the majority of it is in build-to-rent. It's in new stock. Why do you think they're steering clear of existing stock, and what are they missing from your point of view? Because obviously you're focusing on that.
Yeah, I think I think it's a natural progression. So again, looking at existing homes, the model, again, looking at the US and Germany, acquiring existing homes is a very mature market. You look at Invitation Homes, American Home for Rent, the $20 billion plus market cap businesses more, and so it's a very established market over there. The UK is really only just in the last sort of decade really started to get momentum in terms of the build-to-rent opportunity. And so it's a very relatively straightforward way of accessing the market, heavily reliant on building developers to partner with in order to gain access to that market. But it is a natural progression until you start looking at the existing market and seeing that, the need and the opportunity that exists. Again, the UK it's a highly fragmented market, so accessing the existing market is very difficult. It requires, if you've got 97% of the private rental stock owned by individuals, and over 60% of those have less than 5 properties, you have to have a consolidation entity that can acquire at scale and pace in a sort of very small unit number. So I think complexities around fragmentation and also a lack of data and a lack of, or everybody loves innovation, but no one wants to be the first. So it's understanding that market. We have a very old stock in terms of build. We're the oldest housing stock in Europe. So there's a lot of caution around obsolescence and what that looks like, and understanding the capital replacement cycles of these assets, whereas a new build is very much easier to understand. So I don't think it's certainly not a reluctance over the sector. I think everybody's aware of the strong fundamentals of the sector. A significant structural imbalance between demand and supply, and everyone sees the long-term return potential and resilience of those returns. It is really a matter of building up the data and getting comfortable with that risk-adjusted nature of those returns for the existing stock versus build to rent, whereas actually you're offering very different risk profiles, even though you end up ultimately with the same exposure to the same asset.
So on that, you operate mostly in the north of the UK, where values are lower. How does that affect your investment model versus, say, a high value area where you've got capital replacement issues like you kind of just mentioned?
Yeah, it's really interesting. I mean, we operate across the UK, and from a value perspective, we're actually relatively evenly spread across the UK. But given that the relative values of the assets in the north and south, we, as you say, we have a much higher density in the northern units. Interestingly, when we started building the model and the technology platform a few years ago, our key driver was to A, understand how much volume there was in the market, and B, understand how we could stabilize those assets, and then how we could manage them from a national perspective, or from a centralized hub. So what that gave us was an understanding of a UK-wide portfolio against all types of archetypes and rental values. And actually, it's only as that portfolio is now maturing and we're starting to see the data, we can start to see where those opportunities sit in that stock. And what you see is actually there is a really interesting relationship, and it's kind of intuitive, but to see it in data is really powerful, because what you see is, as you would expect, is a bell-shaped curve in returns. So as values of properties increase, the yields reduce. And so as you would expect, you've got a much lower gross yield down in the south where property values are high versus in the north where they're low. But even within northern regions, you will see the same bell-shaped curve where higher value properties have lower yields. And there is a kind of a sweet spot in those yields. So in the lower value assets, such as the regulated social homes where rents are heavily subsidized, the rents are too low to compensate for the cost of that asset.
Operational costs.
So
costs,
an 80 square metre, 2-bed terraced house costs, X pounds to run per year. It doesn't matter whether it's in Teesside or whether it's in
there's always a floor,
in Guildford.
isn't there? Yeah.
You've got, so many
Gas
windows, so
safe.
many doors. The costs are pretty consistent, give or take a bit of labour costs.
I always use that kind of analogy of changing a fire door in Mayfair versus Aberdeen, and it's
exactly right.
2% of your rent roll in Mayfair, and it's 200% in Aberdeen.
And that's exactly what you see. Yeah. And so what you see is that as you get to the lower value homes that are subsidised and the rents are low, the fixed costs of running that property start to erode your net rental income. Equally, as you just said, at the much, much higher end, what you find is your fixed costs of running that property are significantly less than the rent, and so you have a much higher gross margin. However, what that neither of those take into account is the value of that asset. So what you find is at the upper end of that spectrum, rents top out. Unlike house prices, which don't, they have different drivers. The house prices are driven by credit availability and all sorts of different things, whereas rent is largely driven affordability by wage growth. So it highly aligns with wage growth and inflation. So as the values of the properties push up and them up, rents don't follow that trend. They grow but then flatten off. So what you find is your net rents grow, but then they start to decline as the values of the property increase. And there's a real sweet spot in the middle where you triangulate cost of the entry of the property versus rent versus cost of running that property to understand where net yields are strongest after all your costs.
Because as well, it's not just about the net yield, it's about the total returns and the capital value, as you've mentioned. Again, we're in London today, so I'm kind of biases to the south and higher value kind of areas. But we find that, 95% plus of your total returns over, say, a 10-year period will come from the capital element versus the income. Now, you go to lower value areas and the rent becomes a higher percentage of that total return. But again, still, it's typically the capital value going up. Is that what you find, or is there something different?
So for G2M, we like cash.
Yeah,
cash is king. And capital values are interesting, but over the long term, you can measure that total return. But we are very much yield driven, and so we absolutely focus on underlying net cash returns. So you have a significantly higher net cash return in a lower value northern asset than you would in a southeast assets. A 4% in the south versus 6% in the north. Now, over time, the capital appreciation may be greater in the south, but that cash return ultimately is significantly greater. So you end up in a position where over the long term, your total returns are actually not dissimilar. It's just that in the northern regions, it's largely made up by cash, whereas in the southern regions, it's made up by significant capital return.
So really your kind of model is more like a pension fund where you're looking at kind of the generating income. But I mean, I guess you've always got to have a view of the value, especially if you're using leverage. And at some point, if you are to exit things, you don't want to buy something over the value of what you would sell it for and things like that.
So I think you touched on a really interesting point there around exiting and liquidity and crystallizing the value of that investment. And it actually goes to the heart of one of the fundamental issues of our market in the UK and what drives our problems in our housing stock, because it's easy to think problems in our housing stock are driven by shortage of supply, whereas when you look at it, 40% of temporary accommodation demand in the UK is driven by people being evicted from their property. It's not that they can't stay in there. It's not that the property doesn't exist. It's that they can't stay in that property that's the problem. And that's because private landlords need to exit those properties to crystallise their retirement and to crystallise them to.
Well, I guess you could argue another way that private landlords are picking up the slack of the social housing and being kind of social housing because there's not enough of the social housing. So private landlords have basically stepped into that model where really they've kind of got no right to. And
well,
yeah,
well, that's an interesting point. I actually see, and we'll come back to liquidity in a second, but actually on that point, again, going back to Thatcher and the 80s and the law of unintended consequences, part of that drive for home-owning democracy was the right to buy scheme. And through that scheme, 2.1 million social homes have been sold into the private sector. Now,
and
the
not
reality
rebuilt.
Is, well, we've built, but the reality is, it's those 2.1 million homes that have ended up. I mean, we have been building stock, but they've ended up in the private hands. Whereas actually, what that's done is then restrict your social stock. If we still own those, if you look now, there's 250,000 people demanding temporary accommodation today. Now, the average social resident has a tenure of about 10 years. So if you took those 2.1 million homes, the churn of that stock is just over 200,000 a year, which oddly equates to what your demand is. So social stock is about owning more stock, not necessarily just building it. So by selling those homes into the private sector, it's been one of the largest, from a real estate perspective, the largest forms of self-harm that we could have ever done as a country. We need to get those back.
And also, if you look at the amount of people that live per square foot in accommodation, rental versus owner-occupier, you have far more people that live in a rented 3-bed terrace that's 100 square metres versus the amount of people that live in your own home that's the same size. And so every time a rental property gets sold to an owner-occupier, on average, you get a net increase in homelessness or a net increase in people going onto the waiting list.
Exactly.
Which is another issue.
Yeah, you're absolutely right. It concertines down.
Yeah.
So there is a large push towards home ownership, and that's great. Everyone wants people to own homes. I mean, I think that does one of two things. It drives demand for property and drives prices. And so anything you do to stimulate that market through Help to Buy is going to make affordability issues even worse. And secondly, the reality is for if not majority, but a vast number of people and households in the UK, they simply will never be able to afford a home. And so you end up with this problem where a owner-occupier and owning your own home is great if you can afford it, but affordability issues are pretty much entrenched in our society now. And so we have to recognise that for millions of people, they will never be able to afford a home, despite the desire to do so or the ambition to do so. And so as those homes do transfer into owner-occupiership, what happens is, as you say, the affordable rental homes diminish, and they then concertina is down, so everyone starts pushing down that spiral.
And it's the bottom percentile
that gets left going into
really
temporary accommodation.
Yeah, exactly.
So going back to the preserving and affording those rental opportunities is key, as well as building new stock for owner-occupiers, who I think building for those wealth generators and wealth creators and those homes that we need as a country to attract the wealth creators. That's great, but we need to preserve those rental homes.
We need more affordable rentals and social rentals and things like that, I think.
Yeah, and I think that is again, another interesting topic. I really don't like the term private and social as nomenclatures for the two sectors that we have, because it implies the social sector is full of social residents and the private sector is full of private residents, and that simply isn't the case.
Yeah.
We have millions of social in nature residents who are relying on the private rental market, and that tenure blur is again one of the real issues that we see, and something that G2M tries to address through providing, despite operating in the private rental sector, we align completely with social regulated framework. So we're providing a socially oriented rental platform, and I think that's actually as the market should be. So the more rental reform is needed.
And how do you define how do you define that? Is it based on affordabilities of the area? Is it, we hear about kind of like LHA rates being the 30th percentile, which, I mean, if you look on Rightmove, you'll be lucky if you reach 2% and things like that. So how do you measure whether you're achieving that or not?
That's a real hot potato. So, affordability, looked at it in financial terms, is really not a useful metric at all, because actually what is affordable for one household is not another, and yet they can have the same income, into that household, and yet one can afford it, one not, because their circumstances are very different. So for us, we talk more about sustainable tenancies and a sustainable rental model. Giving a household or a renter the information they need to understand whether it is affordable for them is first and foremost. So enabling them, giving them the information around what it costs to run that house, the utilities, and enabling them to make that decision. And once they've made that decision, that people aren't stupid, they know what is affordable for them and not. Then actually, it's about putting a framework around them that enables that tenancy to be sustainable. So, we align with the CPI +1, the government rent control increase. So whilst ever a resident is in our property, they're never going to they're very predictable in terms of their rent increases. We wrap elements around that of affordability to help them. So welfare awareness is a good example. You have in the UK about 19.5 billion of welfare that goes unclaimed from about 7.5 million people who simply really are not aware that they can claim stuff that they can't. So we put in processes to help them become aware of those, and so they can start claiming them to help them afford their rent and be able to afford, generally increase their net income levels. So affordability for us is not just about income and not just about your ratio, because what you'll find is someone who's reliant on welfare, that is 60% of their income is going to be taken by rent. So, and also on that point, we see in our data no correlation between affordability and bad debt and arrears. There are other drivers to that which are lifestyle driven. So for us, what that enables us to do is enable to work with our residents to be able to not rely on income as a factor for them to rent our properties. It enables us to have a much more diverse resident base that is not income driven, because we understand what drives those arrears and bad debt rather than income.
So let's get on to the data then. So obviously data is important to you. You've mentioned it quite a lot kind of going up through. So what are some of those key data sets that you want to keep your eye on?
Obviously, there's lots, and the financial metrics are all fairly obvious, I think, and important, but they are critical, but they're pretty predictable, and so we understand those completely. For me, anything, and as CEO of the group, anything that goes to risk has to be at top indicator. So we operate in a sphere where reputational risk is paramount. From any institutions, pension funds, annuity funds, any institutions investing into housing is taking on, the responsibility of running someone's home, which is, highly emotive, and understanding reputational risk and managing that is critical. So interestingly for me, one of the key indicators, the first indicator that I flick my eyes down to is the resident satisfaction levels. And whether that's resident satisfaction when they're leaving a tenancy, or whether we've done some work for those, or complaints. And then after that, we then have a series of risk dashboards across the whole business, whether that's in gas safety or compliance, decent home standards. We comply, as I mentioned earlier, with the social regulatory framework, and so we have a framework for what a decent home standard, which is a regulatory term, which we apply to our stock, which is absent in the private rental sector, but we do it. So it's those indicators that are critical. Anything that monitors and measures and mitigates risk is top of the list. So
what's the biggest risk to G2M, and what are you doing to mitigate it?
I think so. It's heavily influenced by the market and by what's going on in the market, particularly in the news and the narrative. We hear lots around damp and mold, and and I think it's really significant in the social sector. Again, largely because the social sector is easy target because they tend to be larger players with larger portfolios. The fragmented private rental sector is much harder for regulators to target and then to try and act against. So you hear less about it. But for me, having first and foremost, again, going back to that reputational risk, having first and foremost a clear resident-centric focus with your second priority being the data wrapped around that means that we can keep our finger on the pulse of what's going on. And so for us, having clear audit trails, communication trails, processes and systems that provide our residents with sort of best-in-class service, but also have that at the front of our mind when we're addressing things. So, if we have a damp mold issue that comes up, as you do through leaks or through whatever it may be, we have KPIs around addressing that quickly, timescales, we have escalation processes if things haven't been addressed. And it's really having a very clear audit trail around that to make sure that we are doing what we say we're doing. And if we don't, then we understand why not. And we have a root cause analysis of that problem and address either the process or the human error. So it's a continual evolution of risk management.
That's really interesting. And it immediately made me think of that audit trail and kind of going back to roles and responsibilities, and kind of when you're a managing director of a company, you're leading from the front, it's high pressure, it's a stressful job. And then I guess you've got the shareholder role that sits kind of one step behind, but there still needs to be an audit process because there's still these KPIs that they've got to look through once a quarter, and when do they need to get under the hood? And how has your role kind of shifted as you've grown the business? Are there any kind of examples of that where you've kind of been doing the day-to-day and then you've had to ensure that process is really robust so that you can then audit something in a way that's not going to take you as long as it would do to do the whole thing anyway, because that's pretty pointless. But is there anything that kind of springs to mind where you go, because we're talking about data and sort of some of these metrics that you're looking at, that you go, right, here's the audit process for this to make sure we are, as a business, kind of keeping on track? In this goal. Sorry, I put you on the spot there.
No, it's a really good question, and it's interesting. We've been, as G2M's, been running for 12, 13 years now, and if you think how that evolved, as a growing business, when you start, you as a founder, you're kind of doing all the roles, and you're building it out, and you grow. And so, very much earlier on, it was a combination of deploying capital and actually, the whole business was run off spreadsheets effectively. And it wasn't until sort of 2021 where we started developing the technology to build out the platform. And also then, as a business, imagine we were initially, as a G2M, was a consolidation of the operating activities and its investment activities. And so a year and a half ago now, we demerged those activities to create a very clear divide, still part of the same group, but a very clear divide between the investment arm of the group, which is G2M, and the operational side of the business, which we called Hebodal. And Hebodal is our resident-facing brand and operation that sits behind. So all the risk management process all sit within that operation. And so up until 2 years ago, those were all sat on my shoulders. And then I brought on board our COO, our Chief Operating Officer, Teresa, who's done an amazing job in picking up that operational role and taking all that responsibility in the operational management to one side, enabling us then to start looking at the investment side and bringing us to where we are today, which is presenting the opportunity to institutional investors to recognize the need and the investment opportunity and scale. So my focus has shifted from being entirely operational side into building the capital markets team and driving that messaging and jumping back into articulating, as we are today, where we see the opportunity, where we see the need, and become a thought leader in the market, which we are, because it's a new subsection of the real estate market and, a new asset class. And so there's a need to educate the market and to understand the issues and the drivers behind it. But I still occasionally like to get my fingers dirty, and occasionally we'll flick onto our platform and go into a property and have a look around and spot the occasional thing that I think, well, that looks interesting, and I'd like to understand that a bit more.
Yeah.
But Teresa does an amazing job now, so thankfully it's the need for me to get into that level of granularity is not that necessary nowadays.
It's funny because whenever I speak to people who've grown businesses, we always ask them what's the biggest challenge, and more often than not, the answer comes back with staffing. Staffing challenges growing from a 5-person team to a 20 is a completely different culture, because where the founder or the CEO has been available to speak to everyone all the time, it suddenly changes, and lines of communication, that can be really tricky for some. Would you say that's fair? What have you found as the biggest challenge?
Absolutely, 100% fair. Yeah, 100%. And if you'd have asked me sort of 4 years ago, I probably would have been in the camp of culture as one of these things big corporates need to worry about. And it's not really that important. And and actually, as you get uglier and older, you kind of realize that actually it is really important. And understanding what your culture is and leading by example, really, because you can define what it is, but unless you're actively doing it, and leading by example and reiterating what that is, and that aligns with the shifts in the focus in the business and an understanding of moving from, I guess, 5 years ago, where it was all about the financial metrics, and that led the whole conversation around, what are we buying, what discount are we buying things at to enable us to retrofit and to upgrade and to get the right yields and what the yields are, and it was very heavily driven. You look at that now, it's completely resident focused. Well,
I guess the resident focus looks after the investment side.
Exactly right. It's common sense, but the problem with the common sense is not that common.
But also when you're growing something like an investment business, which is what it is, with an asset class that is this very illiquid assets, it takes an awfully long time to get to that point of growth. Like, you churn away and churn away and churn away. It's very different to that trading model that your business partner probably came from, where you go. And it's always interesting to speak to people kind of from that trading kind of background who have come in and gone, well, actually, we're going to move into an investment zone. What have been the challenges there?
Yeah, you're right. I mean, it is interesting, because it's interesting there when you say, I guess property and residential property is kind of semi-liquid. Real estate people tend to see it as illiquid, and actually, the residential market is the most liquid real estate asset class in the world. We can trade, and we used to, not now. We trade stock in days, almost back to back. It was a very, very liquid market. And that still has huge power in terms of the investment model, that we have, and understanding that.
But I guess that goes back to your valuations, though, because it's liquid. I mean, it's the old kind of adage of, right, I'll give me that property, I'll put it on the market. You might have a buyer in 6 months and it'll be 200 grand, or I'll buy it, stick it into auction. You might have hammer goes down and they'll complete in, 40 days. Or I'll give you, and that's 150 grand, or I'll give you 100 grand and I'll complete in 24 hours. So that's the time. That's the time element. Yeah.
You're 100% right. There's a couple of points in that, and I guess one is that there is a natural trade-off in acquiring as a cash buyer. We offer vendors of property a rapid execution sale, and particularly for landlords who, much maligned in the press, but the vast majority of landlords that we see have, a desire to look after their residents and tenants, and they don't really want to evict their tenants if they don't want to, and they have to rather. But the reality is houses are worth more vacant than they are with a tenant. But in those instances where the landlord wants to retain their tenant, we will acquire those properties, and so we can offer them a rapid execution, and there is a natural trade-off to value for doing that. So, but then the beauty of on the other side is that the UK market has vast amounts of data, data points, and you can very, very accurately measure value, rent, and analyze that out very, very quickly. And so with a sophisticated platform, you can start understanding where the arbitrages sit. So if you know, and what the reality is, the market as a buy-to-let landlord or as an owner-occupier, you're selling your home or that asset into a market. It's actually largely disconnected from yield, your decision, whether to sell or not. You're often, if you look at the buy-to-let landlords in the UK, they're nearing 60.
What's the famous phrase to say?
60s.
It owes me this much. That's totally irrelevant.
Exactly, but you're exactly right. They are very equity rich.
Yeah,
They've been in it for a couple of decades. And so it is not driven by yield. Whereas we take a very yield-driven approach, and we know exactly what it costs to run an 80 square metre, 2-bed terraced house up in Teesside. And so what we can do is very clearly overlay the data onto the market and spot where the arbitrage sits.
But my point was, it took you a while to get to know that data, didn't it?
Yeah.
So it's that whole thing of actually, liquidity is probably the wrong word, but it's the time frame to understand actually the asset class that you're in. And it's fantastic that we've got data now, but it's also a bit difficult to go, I don't know, if you jumped in now from the start, yes, you've got all the data, but how do you understand it and analyse it? I think it's still a long-term asset class in that 100%. Regard. Yeah.
And going back to what you said earlier about, institutions getting into the market and what, their cautiousness or stepping slowly into the market, I think that is a key point of it, because if you look at the evolution of our business and the learnings that what we've had from, the last few years of investing, understanding an asset, not just what its value is, its market value or what its rental value is, but understanding what that looks like to maintain that property, isn't available in the market. To know what a 80 square metre 2-bed terrace house costs to run every year isn't available, and you can only build that from your own data sets. But also understanding and having the sophistication to overlay a capital replacement cycle on that asset. So, that becomes paramount, because once you take up that 2-bed terraced house and you've put new windows, new doors, new kitchen, new bathroom, roof, it's exactly the same as a new build. It's just you've just got a capital replacement cycle, and it's putting that investment case right at the beginning before you've even made the decision to buy it, and understanding what that looks like then gives you the arbitrage potential to say that's undervalued to us.
Yeah, absolutely. We went off piece there, but I'll bring us back round. So, where do you see the opportunity in UK housing as an investment, and what would have to happen for you to change your mind on it?
Well, that's a very good answer, very good question, really. And I think, the opportunity of the market it's a very nascent opportunity. If you've got, if you look at, again, the narrative at the minute is very much around build. And yes, we need to build more properties as the population grows. But there is a need to shift that narrative a little bit and say, okay, let's have a look at what's causing some of our issues in the society today, and look at the opportunity around why these landlords are exiting. Is because they're getting older and there's a rental reform or regulation coming. And so the opportunity to target those landlords who are becoming very motivated to exit the market.
Well, it's funny, isn't it? It's because it's like this phrase, tired landlord.
Yeah.
And when you think about residential property and investing in it's direct investment. You are investing in something that is operational, and it's far more operational than it used to be. And at the same time, you've got an investor who probably bought it at age, 50, and now they're age 65, and they may not have the energy, want, desire to be as operational as they were. And on top of that, you've got the regulatory stuff that's making it more operational and more. So
exactly right.
Yeah.
The motivation is increasing, and they're becoming aware of that. And that, with motivation, becomes an increase in the trade-off to value towards exiting. And so, we monitor that continually as we see the market. So, there is clearly a need, to grow our stock in the UK and to build. And I think that presents opportunities in the form of build to rent, whether that's multifamily or single family, and each have their own different risk profiles and whether you for or against build to rent. But the opportunity in the existing market is vast. It significantly dwarfs any kind of new build opportunity.
Yeah.
The market is absolutely vast. We have 300 billion a year of stock changing hands, and we can see all of it. And we can look at every single one of those properties and determine which ones we want to buy and which ones give us optimal returns and present long-term opportunities.
So what would have to happen for you to change your mind on that model?
I think it's when the market starts getting disrupted in really political ways. I think you have to continually monitor it, in which we do. Political risk is whatever sector you're in.
Yep.
Particularly housing. You have to be continually aware of the political risk, and I think incentivizing new first-time buyers is, I think, very problematic, both for the market. It starts to distort pricing, and so you have to be very careful of what's happening with pricing in the market. But again, we see that from returns. But also, I think there are wider rent reform that if we have to be very careful, not as a market to be wary of the law of unintended consequences. But rent controls, for example, it doesn't. For us as a business, we're
Probably
already
a good thing, rent controls for your business, wouldn't it? As long as it goes up with CPI or something.
Well, exactly. We're already, so again, part of
CPI
that risk mitigation, we already align very heavily with the social regulatory framework. So
what an opportunity to pick up market share.
So our business is all about, actually, we are all for greater reform and greater regulation in this instance. But I'm very aware that if we start to try and control rents too hard, you try in Scotland, for example, it doesn't end very well. And in fact, but having said that, Germany's had rent controls for decades, and the market's been absolutely fine.
But it's the way,
it's
again, it goes back to your comment on unintended consequences, and the same with kind of buying schemes. So like your Help to Buys, but before that we had all sorts of buying schemes as well. And I put something out the other day about how buying schemes have affected actual affordability over the long term, and it's very interesting because you've got, like you say, the pricing issues that it causes for buyers, but on the other side, you've got the motivation to build as well. And so when we've got the first quarter of this year, we had 23 out of the 32 London boroughs who did 0 housing starts. Now, that's not to say it's down to no Help to Buy, but there's other factors in there. But there's all sorts of things that happen from, well, these unintended consequences of putting in regulation. And I guess it brings me on to a very long-winded way of getting on to our next question about regulation. So what effect do you think it's had on the market in the last 10 years?
So I think it's been interesting because there's lots of noise and the rent reform has been in the pipeline for a long time. And actually, it's very, very difficult to implement. We've had not only the rent reform ticking away in the background, but also the minimum energy efficiency standards, the MEES, coming in, which has been put back and put back and put back. And that on the energy side, that acts as a big motivation for landlords to exit. The reality is, lots of landlords, if you've got
especially in lower value areas.
Well, I was just about exactly right. If you've got a house, again, going back to the 2-bed terrace house in Teesside worth 70,000, and you've got to put external wall insulation on that, it's 10,000, whatever the number is. You've got a 2-bed terraced house in Berkshire, it's worth 400,000. It's still just over 10 grand to put that wall. But the impact on those two landlords are very, very different. Mm-hmm. One, it wipes out their retirement and they're in a real problem. So you get this huge north-south divide and they just don't have the resource to do it. And the area doesn't have the skill and expertise to do it. And so, we're very much focused on working with local partners, bringing in local contractors and local supply chains in order to increase their skill levels and resource expertise, particularly around retrofitting. And so we build up those supply chains to enable us to do it. For a private landlord, it's very hard, and regulation, whilst welcome, is problematic for those landlords and problematic for us as a country.
Well, it's how it's brought in, isn't it? And like you say, it's been kind of every kind of year we hear about energy performance certificates and how they're being rated and how that needs to change, and will it be this year that actually they bring in those changes or not? And makes it very difficult for businesses like yours to actually allocate capital to do things where you think, well, hold on, it might be measured in a completely different way.
100%.
And so, yeah,
it is.
that
and
can be
for us,
tricky.
again, part of our key driver is when acquiring assets is to triangulate the cost of the asset versus income, and part of that cost is an understanding of the retrofit need and increasing to a C plus status, and we build that into that investment case. But I think so. The fluctuating in and out doesn't help. It needs to really, so regulation for that needs to be brought in and needs to be put in over the long term so it can be implemented.
Investment
in a proper way.
needs surety. You need to
100%.
know what's happening, even if it's going to be bad news. At least you know, and you can act on it. It's
100%. And likewise and that was exactly the right point, because likewise on the rent reform, regulation's great and regulation's very strong. I think you've got a few million private landlords that are really going to struggle with it. And again, increasing their levels of motivation to exit, which from our sense is great, but for the market isn't.
And it's not just regulation, it's the enforcement of that regulation. Because, there's a lot of the regulation is already out there. It's just not enforced. And so it's how does it actually, it's like the licensing schemes and things like that. It's like, are they going to get enforced? Because otherwise you're just kind of creating it for the sake of creating it.
So you're right. The regulation out there in the form of selective licensing is very patchy. These are where licenses are given to, or landlords have to apply for those licenses. Now, it's not consistent, so every authority has a different element to it, and so some tweaks and here and there in terms of the requirements. So it's very inconsistent, and it's very it's very difficult for them to enforce and very expensive for them to enforce. And so getting greater consistency across that piece is pretty critical, but it is almost impossible to regulate 2 or 3 million landlords. It just simply isn't the case. And so hence the market needs consolidation, which is again part of our thought leadership and you're seeing it already in the market. There is a need for those two sorry, that's my phone. Yeah. For the market to consolidate up, and being institutional landlords is part of that.
So what advice would you give to someone who's looking to start in a career in real estate investment?
Oof, that's a good question. Come and join G2M, really, part of our family. I think really understanding what it is you want to do in real estate. It's a big market, and there's lots of interesting angles to it, whether you're working on the investment side or whether you're working on the surveying side. I think for the real estate market, there is plenty of opportunity across the breadth of the sector, and it's a sector that's starting to change, and I think technology also is rapidly impacting on that market. So I think that introduces a new element to the drive to improve the sector. So definitely think technology and think data.
I agree with the kind of big business in terms of get some experience of buy side, sell side, and asset management, and then you can kind of choose, right, what do I like and what do I... Yeah, exactly, yeah. And last question, I think. What is the kindest thing someone's done for you in business?
Oh, that is a good question. I'm going to have to go right back to the start, really. I think that has to be my father, really, who's no longer with us, sadly, but he was from the genre of buy a home, get on the housing ladder, everything that probably is wrong with our housing market today. But he when I went to university, he didn't want me to go to university. He wanted me to get a trade. He was a builder and saw that as important. I kind of had different ideas. I wanted to go to university, but he was not going to pay for me to university. So he said, I will lend you some money to buy a house, and you can rent it out and pay for your way through university. He made me pay that money back with interest 15 years later.
Brilliant.
So it was a good lesson, and not only that, it put me on the housing ladder today. But so I guess through his desire not to pay for me to go through university, but his generosity in making it happen, still is I've got a lot to be thankful for. So yeah,
fantastic. And I'll do one more bonus question just based on what you said. So you talked about kind of the risks in your business, and I think, and we talked about kind of scaling businesses up. And one of the things that I kind of find is that the smaller your business, especially in property investment, the more dangerous those idiosyncratic risks are, like, I don't know, having a bad tenant in one, or I don't know, a fire in another, or the wrong insurance things like that in a property. Whereas as you scale, those risks become much more less impactful on your overall business. And how have you found kind of changing your priorities? Have you found it being quite an easy thing to kind of go from, again, that operational side into like observing the business as a whole? Or has that been a bit of a challenge?
Yeah, so I think it's interesting. I think firstly to do what we do and to aggregate the market, I think it's important for us to be a vertically integrated business. So, we need to integrate both our investment management aspect of our business with the operational side. Having that seamless integration between the two when you're rapidly aggregating a fragmented market is critical. And I think that understanding between the operational and the investment side are key. And as we've grown, we absolutely recognize what you've said. You see, if you've got 5 properties and one of them becomes vacant, you've got 20% of your portfolio that's empty. As you scale to several thousand properties, that becomes less of an issue. And what you start to see then is the underlying trends and that trend data. And so you can start measuring your performance of your business by an expectation of what those trends are. And you can only do that once you have the data and the aggregate and you understand what it looks like.
So what we're saying is once you scale, life gets easier.
It definitely gets. Yes, it does. I think it certainly gets more predictable.
Yeah.
But equally, as you scale and as you become more institutional in nature, you start to focus on governance and risk and those aspects which take a bit of a backseat when you're growing in the earlier years. You start to realize actually it's all about performance in the early years, and it still is about performance.
Well, it's moving from private equity to fixed income models almost, isn't it?
Yeah, exactly right. You're basically, as soon as you start looking towards the long term, and the reality is housing infrastructure, which I see it, is long-term asset and requires long-term asset management and long-term planning and therefore long-term investors. Mm-hmm. As soon as you make that connection, you then have to understand governance and risk and all those things that come with it. And so, large elements and drivers over the last couple of years have focused purely around the risk aspect of the business as opposed to the performance, which we understand and measure and monitor and can see pretty clearly through the data, which is nice.
Brilliant. Paul, thanks so much for joining me today. It's been a really interesting conversation. I'd love to get you back on to ask the 20 or so more questions that I've got for you.
I'd love to be back, Ron. Thank you very much for having me. It's
Cheers.
been a pleasure.